It does have a table with us outside. Please make sure to see him if you have any further questions. Our next speaker is Evan Katz. Evan has raised a very substantial amount of capital for compelling hedge funds, private equity funds, and early-stage technology and medical life science companies. Evan Katz is with Crawford Ventures, which is an alternative asset investment firm that forms, grows, holds interest in, and has raised a very substantial amount of capital for these hedge funds and private equity firms. So if we could please give a big round of applause for Evan Katz, everybody.
Well, good morning, everybody, and thanks to Richard and his entire team for putting this on this morning. They always say, save the applause for when I'm done saying something. You may change your mind and regret having given it before, but I've got about 33 slides. We will never get through them. This is a presentation about how to raise money for hedge funds, private equity funds, and a lot of it applies to operating companies as well. If you'd like a copy of the PowerPoint, just email me anytime. It's ekatz@crawfordventures.com, or just Google Evan Katz Crawford, and it'll come right up. But it's ekatz@crawfordventures.com. It's a 33-slide PowerPoint. Also, small correction. The materials say it's best practices from A to Z. That was the original title a year or two ago. We're now up to double R. So that's 44 tips instead of 26. You're getting twice your money worth today. This is what I'm going to be talking about. I'll give you a 30-second introduction as to who the heck I am and what we do, and 9.5 minutes on how to raise capital from institutional investors. And again, this is all in the PowerPoint. You can email me, and I will be happy to send it to you. Yeah, I'll move closer to the mic. How's it? Much better. Okay, fair enough. Thank you very much. Yeah, much better. So 30 seconds on who I am, 9.5 minutes on how you guys can raise money. Went to Wharton, Harvard Law School, twice elected to the board of the Hedge Fund Association, and 15 years raising capital for hedge funds and private equity funds. And there's the email address. You can get the PowerPoint if you send me an email. Our investor base, real quick, we work with about 1,000 institutional and family office investors, the usual suspects. You can read the whole list. Typically allocate about $10 to $100 million per investor per fund. Typical fundraise, a couple of $100 million, maybe more. The Promised Hedge Fund cartoon, for those who know the hedge fund space and/or Greenwich, I think you'll get the joke. A year or two ago here, I said to the entire audience, gee, with the recent fee compression with hedge funds, the cartoon should probably be modified a little bit to reflect current times. Someone in the audience and their graphic arts team then gave me this. So speed limit and times have changed. So again, this is best practices from A to double R, up from Z about twice as much for the same cost. Real quick, I'm going to talk about how family offices are a bit different from institutional investors, and then I'm going to get into best practices for both. Initially, most important thing in the family office fundraising space is hire fundraisers who know what they're doing and who know the people. Family offices are not on lists or databases, although Richard has some very good intros. But get somebody, whether it's a fundraiser or Richard or the family office group, someone who knows the space and knows the people. It's hard to find them otherwise. They don't like to be cold called. So find someone or a good trusted person like Richard or someone in the audience who knows the space who can do it. Regarding, they always say in sales the most important thing is to be fishing in the right pond. So family offices are high tax entities, as the last speaker mentioned. So if your fund is a low vol, low return strategy, that can be great for many people, 6, 8, 10% a year. That's great. The endowments and pensions will love you, and the foundations will love you. But if you're making 6 to 8% a year, it's probably not going to move the needle too much for family offices paying 40% all in. So try to align whom you're going after with the nature of your fund. If you're a high vol, high return fund, the family offices could be the perfect place. But if you're low vol, singles and doubles, definitely speak to them, but you may want to focus more on the institutional side. Also, too, if you are somewhat tax efficient, we get hundreds of funds a year that approach us to raise money for them. Shockingly, if you happen to be tax efficient, long-term capital gains, 60-40 futures contracts, put that on the front page of your one-pager, put a star and a bell and a whistle and a rainbow around it. Most funds don't, because if you are tax efficient, either long-term capital gains or 60-40 futures contracts, and you're making 8 to 10 to 12% a year, well, guess what? For a family office, you're really making 10 to 12 to 14% a year. Shockingly, a lot of people don't put it in their materials, have no idea why. You're doing a lot better than you're giving yourself credit for. Also, point G, the insurance dedicated fund. If there has to be one perfectly legal thing to do to help your investors make more money and to thereby make your fund more attractive, if you're a hedge fund and you're talking to a lot of family offices, consider opening up an insurance dedicated fund. It's a 3-hour topic for another day, but it basically lets people invest in your hedge fund on a tax-deferred basis, which means more compound returns for them, which means you may get more investors than you would if you did not have an insurance dedicated fund. And for some reason, most hedge funds don't, so that can help you stand out as well. One more thing, too. Obviously, look, selling your fund is selling your fund, but instead of just pitching your product, one of the better techniques in the business is try to find out from your potential investors what they're already invested in. So, for example, if you're a hedge fund, you can pull, or your fundraiser can pull, the meeting and investment committee notes for the foundations, endowments, and pensions, see what hedge funds are already invested in. You can usually get their return streams somehow. And then when you're pitching to the institutional investor, you can show them how you are less correlated, not correlated, inversely correlated, and how if this investor gives you X percent of their hedge fund allocation, they're not only increasing their returns, expected returns, but they're also decreasing their volatility. Same thing goes in the family office space. If you can ask the family what hedge funds they're invested in and maybe the return streams, you can hopefully show them that you're not just a carbon copy of the 10 or 12 hedge funds they've already got, but you're, again, less correlated, negatively correlated. It's being a trusted partner, and you're giving much greater value than simply saying, I'll give you my wire instructions, please send the wire by tomorrow. This slide, pretty self-obvious. Don't forget the multifamily offices. These are the pooled family offices that represent multiple families, as few as 2 or 3 or 4, some 50 or 100. If you get in front of them, you can hopefully increase the speed and size of your fundraise, although typically each family has to make their own decision. So that brings us to the OCIOs. The OCIOs are the outsourced CIOs, and these folks actually have the authority, as they call it, to pull the trigger, so to speak. So if you can persuade one of them that your fund is a good investment, you can hopefully get multiple allocations more quickly. One of the most important things for young emerging managers that almost none of them ever do is point I. Go to market when you are investor ready, institutional ready, at least to some degree. So one of the things that drives me crazy about the industry is we get calls from managers and emails from managers looking to raise capital. It's 2 guys, a gal, a dog, and a Bloomberg. Sometimes they don't even have the dog. And basically, they're making great money for their investors, but they've got no assets. The AUM is under $100 million, and they're kind of running things on a shoestring. It's a one-man band or a two-man band. And one of the pieces of advice they give them a lot is, well, can you get some real people in there? Can you get some better service providers? And they always say the same thing, Evan, it's a catch-22. We don't have the money to have great service providers. We don't have the money to hire staff. And I said to them, well, how about this? What if you sold 20% of your business, the actual management company, to some of your friends and family who know you really well for 20, 15, 30 years, whatever, sell 20% of your business to them, raise a couple of $1 million of operating capital, and hire people. And the first reaction of the manager is, oh, no, I'm not selling any part of my business. And I said, okay, that's good. So right now you own $100 million of a $50 million or $20 million hedge fund or private equity fund or venture capital fund. If selling 20% of your business helps you get in some good people, a real CFO, some better service providers, hire a real marketer on a full-time basis, and you can go from $50 million to $500 million, which is better? And get out your calculators for this. Would you rather own 100% of a $50 million fund or 80% of a $500 million fund? Do the math. So that's probably one of the biggest tips, point I, that most fund managers don't do. Pass the hat, go to your friends and family, raise some money so you can build a real business. And if, as I like to say, Bill Gates and Jeff Bezos and Steve Jobs didn't become billionaires because they own 100% of Apple or 100% of Microsoft or Amazon. They sold parts of their company, they built a successful business, and they ended up with whatever the number was, 20, 30, 40, 50% of a billion-dollar operation. Same thing on the hedge fund or private equity side. Point M regarding service providers, another similar point. I'm not going to belabor it. A lot of people love to save $50,000 a year by having some no-name service providers, including an audit and admin or 2 of those. But guess what? If you save $50,000 a year with no-name service providers, that's great, but if you've got well-known service providers that helped you raise assets, you may be losing out on $1 million or $2 million of fee revenues to save $50,000 on an admin and an auditor. So probably not the place to try to save money. Point N and O are interesting points too. Sometimes we see managers who have fascinating fee structures. I mean, you could have a 3-beer conversation or a 4-beer conversation about their fee structures, and they're better for the investors, and here's 100 reasons why, and here's a white paper, and we've done the analysis. That's wonderful. I've told these people, keep it simple, keep it down the fairway, as the golfers say. Investors get thousands of pitches, keep fee structures. Oh, Evan, this is better, and here's 20 pages as to why. I said, great, but guess what? We're going to spend half our calls with the investors discussing the fee structure so they understand it if we ever get to that point. So don't. Just keep it simple. Same thing with fund entities. Every investor in their investment committee know Delaware and Cayman, which is how you pronounce it, actually, not Cayman. So stick with what everybody knows. They're getting thousands of pitches. You don't want to be the one with the Kansas LLC, even if you live in Kansas. Real quick on hiring a fundraiser. It should be obvious, but it isn't always. Hire a fundraiser who knows your strategy and has experience with funds of your size. I mean, sometimes we hear horror stories of someone who hired a great fundraiser. It didn't go very well. Well, why not? What happened? Who was he or she? And it turns out they hired someone who used to be off the muni sales desk selling munis to small governments and didn't know anything about hedge or private equity. Almost out of time. I'll go through a couple more slides, and then we can probably no time for questions, but you can download the whole PowerPoint. Wrapping up in maybe 60 seconds, again, it's a numbers game. Hire someone who knows hundreds of investors because it's a numbers game. You're making hundreds of phone calls to get dozens of meetings and allocations. And quickly determine who's interested in what strategies. I hate the sort of flavor of the month, what strategies are in vogue. But if an investor is not looking for your strategy, don't waste time. Focus on the ones who are, and make sure that you and your fundraiser are calling the appropriate person at the appropriate fund. Like I said on the slide, Mary covers hedge funds, Steve covers private equity. If you're selling a hedge fund, make sure you're speaking to Mary, not Steve. You're wasting your time if you're speaking to Steve. And as mentioned on the slide, this even gets broken out further. Bob does long short, Rachel does quant. If you're a quant fund, make sure you're talking to Rachel, not Bob. Also, too, if you are an emerging manager, I think the room has a lot of them, make sure that you have a fundraiser who knows the emerging manager investors. Out of the 1,000 investors we work with, probably only a couple of hundred do emerging managers. So again, make sure you're fishing in the right pond. If you're an emerging manager, make sure you hire someone who knows those people, not someone who's only raised billions of dollars from CalPERS. It's going to be the wrong fit. And maybe I'll wrap up because I'm out of time with just point V. Get to know and be very nice to the investors' administrative assistants. Shockingly, there can be some egos on Wall Street. I know that's hard to believe. There can be some egos on Wall Street, and I've seen PMs or fundraisers or whoever it is not always be kind, polite, and nice to the administrative assistants. And guess what? They are often the people who are setting up the meetings, setting up the calendars, prodding someone on the investment committee, gee, did you read Evan's documents or Steve or Mary's documents? So always be nice to everybody, but that's a point I'll end on. Do we have time for one question or no? One question, if anyone has one. They're free. All right, fair enough. Well, and one last thing before I step off, make a fund video. It sounds kind of kitschy, but in today's world of CNN and YouTube and Bloomberg, everybody watches videos, and it gives investors a free 2 to 3 minute, no more opportunity to see your PM, how brilliant he or she is, talk about the strategy for 2 or 3 minutes, and it gives them a free look into your fund without making them say, oh gosh, it's going to be a 45-minute call. I can recommend some people who do it, nothing fancy, just something very simple, but we've used it very effectively to raise a lot of capital, and I'll see you at lunch in the cocktail hour. Thank you very much.
Thank you, Evan. Thank you very much, Evan.